We're delighted to have you, Mike, here. For those of you that maybe this is your first time in our webinar series, we've been teaching these webinars for over 12 years. And this year alone, I think this is our 14th or 18th webinar. I don't know, we've been teaching quite a bit, but we've had some amazing speakers on, from Kevin O'Leary to some of the brightest minds on Scott Estel, former senior trial attorney from the IRS. We've had attorneys talking about how to create a legacy plan, how to protect intellectual property, cost segregation on real estate. We've really had some amazing topics, and all of these are recorded, and all of them are available on YouTube, our YouTube channel. And so all anyone has to do to get access to these is subscribe to our YouTube channel. And this is not hard. You go to YouTube and type in Protect Wealth Academy and hit subscribe, and that gives you access to everything that we've done. And so this tonight's event will be recorded. It is being recorded, and it will be available probably tomorrow. It usually takes us a day to get this and scrub it and download it, or whatever we do, and then make it available. And then if you subscribed or told us registered for this event, it'll be sent to you by email, or at least a link to it. So have access to that. We've got 3 big 3-day summits coming up that we're currently taking registrations for. The June event is a live stream event. It's coming up in 3 weeks. We've got another one in August, and then there will be a live event in October. This is probably the live event that we're going to do. It will be in Phoenix, Arizona. It's an airport hotel. We've got a great rate for you. So if you're tired of Zoom and want to get out and see the instructors in person, we're going to do probably the only live event we'll do will be on October 10th. And so register for those. You'd go to protectwealth.com if you're interested in that. The agendas are available. Usually they're posted about 2 weeks before each event, but a sample agenda is available. And you'll see that this is not wussy content. We are serious asset protection geeks. We cover a lot in 3 days. And we're proud of what we teach. We're proud of the instructors we have, and Mike has been such a integral part of what we do in saying, here's what's happening in the market, and giving our students some really good tips on how to stay ahead of the game. So we're excited for that. As with any webinar that we teach, whether it's tax or legal or investment, we cannot give specific advice. We simply teach principles and then encourage you to seek professional help and see whether the principles that we're teaching applies to you. And so with that, Mike, I'm so excited to have you here. And you and I have kind of reviewed what you're going to be talking about. I'm so excited about this. This is going to be a great thing to have for all of our students. Thank you for being on. I'm going to turn the time over to you, but I'll be in the background. And the question before we get started, do you want to kind of save some of their questions to the end, or do you want to try to take them as we go along, or how's the best for you?
Yeah, I like taking them as you go along. If you're thinking about something, throw it up there and just type in the question, use the question and answer. And if I get to it, that's great. If I might say that that's not pertaining to what we're after here. Okay. So turn my volume down. So I like to take them as we go. So that's where I'll go with it. And then if I need to change it a little bit later and say, ask that question later, or email me after class, I'll be happy to take that. Otherwise, as we go.
Okay, let's go then.
Ooh, we like that. If you can make money this down market like that using the proper tools, how cool is that? Yeah. All right, cool. Okay. Don, did you turn it over to me?
I don't know how to, I can stop my share. Can
I'll
you?
do a screen share on my side. I just didn't know if you were turning it over to me and say go with it.
Yep. Go ahead.
And that's what we're doing. So I'm going to share that screen in.
Okay.
All right. Hopefully you see the screen. Hello, everybody. My name is Mike. I'm going to be talking today about some of the benefits of how we can use Wall Street to do some really cool things. Let me see if I can just kind of clean part of my screen off here. We want to probably close that out just a little bit. There we go. Talking about how we're going to use Wall Street and make some money. Making money isn't really that difficult of an item to do once we just learn some of the skill sets. And I'm going to talk about what's happening with Wall Street and some of the things that we can do with it. You can hear me, Don?
Yes. Do you want to enlarge your screen so we see the whole thing?
I think Don wants to read that extra disclaimer on the bottom there, that big disclaimer there.
Am I not using the whole screen here?
I can see all the slides coming up.
Let's go.
Go down to the presenter. There you go. Should. Yeah. Okay. Now go up to display settings.
No, it's going off the wrong one.
No,
sure.
it was the right screen.
Are we using the right screen now?
Yeah. So hit the little presenter button down.
I'm not sure which screen you guys are looking at.
I can see your disclaimer slide, and then all the slides on the left-hand side.
Yeah.
Past and future. So if you go to
Is that better for you?
presenter mode. Oh, well, that's good enough. That's good enough.
Okay.
Okay.
Let's see if I can. Okay. So I got to start with a little bit of a disclaimer here. And the simple disclaimer is just that I'm going to be looking at live charts today on the website. Anything I take a look at, any opinions that I give across, anything I show is for educational purposes only. And I'm not saying that I'm your licensed financial advisor, so go out and just do any of these. Standard disclaimer. So go ahead and read these real quick if you can. Okay, we should be done with that. And again, everything we're doing here is for educational purposes only. So let's go ahead and kind of jump into this one here. Here's a nice quote that Warren Buffett came out, and I really like this. I think it's kind of a neat one. And it just talks about what's happening in the stock market. And I think this is a great one because a lot of people think that we've got to do the things that average people do. And if we do the things that average people do, we're going to get the same results that average people get. And this quote from Warren Buffett said, if I was running a $1 million today, or even a $10 million for that matter, in other words, if I'm running a $1 to $10 million portfolio, so much smaller than what he had, I'd be fully invested. Anyone who says that the size of your portfolio does not hurt your investment performance is selling you something. The highest rates I ever achieved were in the 1950s. Obviously, that was 70 years ago. So he was much smaller portfolio than what he is today with Berkshire Hathaway. So I killed it out. You got to see the numbers. But I was investing peanuts then. It's a huge structural advantage to not have a lot of money. And here's the quote that I like the most. I think I could make you 50% a year on $1 million. And then he says, no, I know I could. I guarantee that. That's the part that I like. In fact, he's guaranteeing that he could make 50% a year on $1 million. Now, the only way that you would ever guarantee you're going to make 50% a year is if you knew you were going to actually make 100% a year. So that's what we're after here. So if you're only going to make 100% a year, why isn't everybody doing that? Why is it that we still give our money over to professional money managers who only get us slightly under whatever the S&P 500 does? And it's because we do what average people do. And if we do what average people do, we're going to get the results that average people get. So my whole goal here in this class is to teach you not to do what average people do and to show you what rich people do. And that's what we're after. Because if he's going to guarantee 50% a year, it really means he's making 100%. So if we're not actually making 100% a year each year, what's going on? What are we actually doing? Whatever we're doing is wrong. And so we need to go back and follow what it is that the rich people are doing. So we're going to show you exactly what it is that they do. So next part, an investment knowledge pays the best interest. And that's why we're here today, because we're going to find out how we actually get through that. So from the time we're little kids, and here's why we think that the way we think, we copy the way that we're told to do. You watch TV and all of a sudden a money ad comes on TV and it says, hey, we've got this great mutual fund, or we've got this great brokerage firm, or we have this or this or this, give us your money. And then they have somebody on TV who looks like a really good, lovable, huggable bear, that's the kind of guy I want to give my money to, or lady I want to give my money to, because they're never going to lose it type of thing. I'm going to give it to them, I'm going to go to work. And you think about that. You're taught that you can't manage your own money, so give it to somebody else who will manage it. And then not only will they manage it, they will live off of your money. So they will live off of your money to pay their bills, because they tell you that you can't live off your money to pay your bills. Do we see the discrepancies coming? And we start to believe that. So from the time we're little, our thought process is skewed the wrong direction. We graduate from, whether it's high school or college, we go out and get a job, or nowadays multiple jobs. You get married, you have kids, you get a house. And then at some point, once you've gone through all of that, you start saying, now I'm going to go ahead and start to invest and save for the future. And so we put the last part last. So we know that we've got three parts of our life. We've got the part where we're living with our parents. You got the part where you finally move out and you have your own life, and you have the part where you finally retire. But we never really focus on the part where we have to retire until it's too late. We wait till way down the line till it's too late to say, I've got to start saving. And by the time we start saving, all the rules you've learned, you got to put 10% of each paycheck away. That's gone. It's too late. We're supposed to when we're 18 years old. So we put to the very, very end of our life the things that we're supposed to be doing to prepare for our life. And you might have 20 or 30 or maybe even 40 years, the last part of your life, based on when you retire. Are you going to have enough money to get there? What are we going to do? We're going to say, I'm just going to go back and get some good mutual funds because that's what everybody else does. So I'm going to do what everybody else does so I can get the results that everybody else gets. Or should I do the things that people aren't doing, that the rich are doing, so I can get the results of the rich? So most common investment plan is to open up a brokerage account, an IRA, 401k, or Roth. That's what most of us are taught to do. We get ourselves a broker or plan administrator, and they tell us what mutual funds that we should go back and buy. So now we're doing the things at this point that 98% of Americans are going to do. Well, if 98% of Americans are not financially independent, why are we following those rules? We decide we're going to hold on to that portfolio. So once we find ourselves a brokerage firm and we turn over that money, we just say we're now in it for the, and we all know the rules, you're in it for the long haul, which is just garbage. Garbage in equals garbage out. I know it's kind of a bold statement, but I'm going to say that for the most of you, probably everything that you've learned up until this time has been incorrect. We're taught two rules in the stock market: buy low, sell high. That's garbage. What's low? Got my hands right here. Is this low or is that low? Is this high or is that high? What about this high? Well, this is now high, but if it goes higher, what was high is now low. So we've got mixed signals all the time. And we say we're in it for the long haul, which is also garbage. Because let's be honest with it. What's the only reason you bought whatever you bought, mutual fund or investment? What's the only reason you bought it? Get to the bottom line. What is it? The reason we bought it was simply for one reason only, to make a profit. So if you're taught you're in it for the long haul, how do you make a profit? Because at some point you're probably supposed to sell, but you're never taught when to sell. Well, I sell when I retire. Is that true? What if we're in a really bad market like we are right now, and the markets are down 25% since the beginning of the year, and now you retire? Is now a good time to start selling because you're down 25% and it's time to retire? No, you're not taught any signals at all what to do. You're taught you're in it for the long haul. And the reason you're taught you're in it for the long haul is the longer you give your money to somebody else, the more things they can do with it. I mean, just think, a brokerage investment house is just like a bank. It's Wall Street Bank. What do you think the banks do with your money when you give them your money? So, go ahead and put your money in a savings account, save for a rainy day. It's hogwash. Once you put your money in a brokerage account, learn to invest for your future versus save for a rainy day. It's two different thought process. And every brokerage firm in North America pays almost 5 times the national average that the bank will pay on interest. Even if you don't even buy anything with no fees whatsoever, just open up an account, put your money there, let it sit forever. There's no fees, but the interest amount is paid more. So why would we ever put that money in the bank? And when we do put the money in the bank, we say, okay, I feel pretty good. I got myself a savings account, got a couple $1,000s in my savings account. So what do you want to do now? Well, now I'm going to go get myself a credit card from that bank so I can borrow my own money back at 25% interest. How cool is that? You see where we're just, that's that wrong thought process. So now you're taught you're going to hold on to those mutual funds until you die. Or maybe at some point we're going to rebalance that portfolio, you're told. So the money managers say, once a year, we're going to go back and look at your portfolio and rebalance them, get rid of the really bad things and buy some more good things. And every time you do that, you're paying some front load, back load, 12B1 fees, custodial fees, inactivity fees. And most mutual funds also collect a dividend, but unless your mutual fund is actually qualified as a dividend fund, almost all of those funds that pay dividend, that money goes directly to the mutual fund company. And yet you're the one that still has to pay the taxes on the dividends because all the stocks in those mutual funds are held in your name. How cool is that? And now you do all that, work we just got through here, and now you say, okay, now I'm gonna go get myself a job so I can pay my bills. But in the meantime, we've just done everything wrong. We've given our money to somebody else, and now they're living off that. That's their lifestyle, but we're told we can't do that, so we have to get ourselves a job. And we work that job to pay our bills. Versus, why can't I just use my portfolio to pay some of my bills, just like the money managers are using my money to pay their bills? Why can't I do the same thing? So for the next 40 years, you're then taught to go back and add some cash to your account. Just keep adding money to your mutual funds. Keep taking money out of every paycheck. Just add more money to your 401k plans. And hopefully the mutual funds are going to grow. and you continue to pay fees to the mutual fund brokers and the money managers, and they continue to take fees out every single year. They say there's no fees, but on average, you can just go to morningstar.com, #1 website for managing mutual funds, and just take a look. The average mutual fund fee is over 3% in North America, even though they say that these are no load funds and no fee funds. There's still fees. Somebody has to pay them. As an example, you buy shares of stock, or you buy a mutual fund, and the mutual fund manager goes out and they buy shares of stock in that mutual fund to add more money to it because you want to buy some shares of the mutual fund. Then somebody else decides they want to sell some share, they want to sell their mutual fund, so the mutual fund manager has to go back and sell some of the shares of stock in that mutual fund. And somebody else wants to buy and somebody else wants to sell. So there's transactions all day long. Well, those are buy and sells. And that means there's always going to be some type of a capital gains tax. Well, where are those capital gains tax? If these mutual funds are no fees, there's no fees involved. Well, who pays those capital gains? And who pays to manage all of those capital gains? And who pays to actually make sure that you are the one who's going to pay the capital gains versus somebody else? Where's all that coming from? How about the accounting department does all that? Someone's paying all those fees. So when they tell you that there's no fees, they're lying to you. The average mutual fund fee in North America is over 3%. So is that really good? Let's give our money to a fund manager and have them take on average out over 3%, and then charge us about 2% per year to lose us an extra 3%. So now we're paying about 5% per year on average just to have somebody else manage our money. Might not seem like a lot, but over 10 years, that's 50% of your portfolio. Think about that, 50%, 5 times 10. Over 20 years, that's 100%. Your portfolio will be about 100% larger. Am I freezing on your end? It looks okay on my end. Anybody else freezing? All right, so your fund manager and brokerage firm both continue to make money while you don't. A little bit scary how that goes back and it works out. So here's how it actually works. You buy your stocks, you buy your mutual fund. The money manager, the fund manager goes back and they buy good stocks in those mutual funds and they put them in their portfolio. And by the way, I'm not saying mutual funds are bad. What I'm trying to get to here is there's just much better ways to invest that rich people do versus the average person. The average person gets in the mutual funds. So now, you buy your mutual fund. The mutual fund manager buys a bunch of stock. Those stocks are now held in their account, and then they give you a percentage of that fund called a mutual fund. They then take that money, all those assets, and they might have $1 trillion in that fund. They then take that $1 trillion, they use it as an asset, and they go out and they invest it the correct way. They buy other companies, they do other business, they buy other funds that are out there, and they make all kinds of profit. And then they keep 100% of the profit for themselves and don't share any of it with you. So they're investing the correct way. And the only way they can do that is to get you to give them your money and leave it there for the long period of time, and then continue to give them even more money in the future. So they're making money off of your money. So you're actually loaning them money. You understand that? And not only are you loaning them money, they're charging you a fee to loan them the money. How crazy is that? Then you take that mutual fund that you have, a ticker symbol, and you put that ticker symbol in your brokerage account. So now your brokerage account actually has an asset in its account because it's a mutual fund ticker symbol. So they have an account that's valued at a certain amount. They then use your account and they loan it to other people, called a margin account. They loan your mutual funds, they loan your stocks, they loan other things out there to other individuals so that they can invest the correct way. And now you're paying them a fee as well. So now you're paying your mutual, or you're paying your brokerage company a fee so that they can loan your money out and make additional money off of you. Do you see how everything comes down to it only works if you give them the money? Otherwise, the whole thing collapses. They need you to believe that you're supposed to be average and do the things that average people do so that they can make their money. And as long as you believe that you're average and will do the things average people do, Wall Street will continue to profit off of you. So in this whole scenario here, who's the only one that actually doesn't benefit in this scenario here if the mutual funds only go slightly up? Because remember, they're going to have to go up about 5% a year just so that you break even off of all those fees. And then on top of that, if they don't go up 5%, or if they go down, or if they go sideways, who's the only person in the scenario that actually loses? It's just you. You take on 100% of the risk, and then you pay both your broker and your mutual fund company, you pay them to loan them your money. That's the mutual fund business. Kind of scary when we think about it that way. Here's an item I got right off of morningstar.com. And really, I'm just coming down here to the bottom line. And it just says, and there's over about 30,000 different mutual funds in North America, equity mutual funds, which means stock mutual funds. And you can see that out of all funds out there, right down through here, year to date, they're underperforming when this was taken at the last year, underperforming year to date. And even if we go out to a 2-year, 3-year, 5-year, 10-year, there's not a single time when mutual funds have ever outperformed the S&P 500. So the S&P 500, which is the benchmark for all mutual funds, has always outperformed mutual funds as a group. So if that's the case, why are we still buying mutual funds if they underperform the benchmark? You can go out and buy the single ticker symbol SPY or the ticker symbol SPLG, much smaller. Either one of those, and it's the benchmark. So if you buy the ticker symbol SPLG or the ticker symbol SPY, you are the S&P 500, and now you get to keep those extra 5% year after year after year. And since the average mutual fund never outperforms the S&P 500, why do we give somebody our money to do that? If we could just buy the ticker symbol SPY, it's 500 of North America's largest companies from all different sectors of the marketplace. So you're diversified. So think about that. And the reason you don't do that, because you're not taught to do that. You're taught instead, give your money to somebody else. So instead, we're taking a look at something called an ETF. That's what we're talking a little about tonight, ETFs. And then we're talking about dividends we collect with ETFs, and then how we do some asset allocation. It's kind of where we're going. So ETFs are fairly new, considered mutual funds. Mutual funds have been around since the mid-50s. ETFs kind of came around at the end of 1999, really 2000, we started kicking off. And you can see their meteoric rise on how much money in trillions of dollars we've got over here in the ETF market. And they're just changing. And the reason for that, when the internet popped up, we started finding out how much money we were actually paying in fees on mutual funds. And so we got kind of upset about it. So we decided, as retail investors as a group, not just me, retail investors as a group, that maybe there's a better way to invest and a cheaper way to invest with much less cost, but many, many more benefits. And that's the ETF market. And you can see they're just growing like crazy. Here's one here. It says how much new money has gone into mutual funds versus new money into ETFs. And you can see there's just a huge difference here over the last 10 years. Huge difference on how much money is going towards ETF new money versus mutual funds. Because people are finding out saying, why do I want to use mutual funds? And in fact, when I'm done with this, you'll ask yourself a question. If your money manager, who is managing your account, actually puts you in mutual funds, it's not because it's best for you, it's because it's best for them. And I'll show you that when we kind of get to the very end of this. So if you're in any mutual funds at all, what's happening is somebody's taking advantage of your account because you're paying them additional fees. They could put you in the exact same ETF, exchange traded fund, that tracks the exact same mutual fund, and the average fee on a mutual fund, or on an ETF, is less than 0.25%, not over 3%, less than 0.25%. So if you're actually put into a mutual fund versus an ETF, it means that difference between 3% and less than 0.25% is going someplace else, and usually to the mutual fund company and the broker who put you into those. So lots of new money coming into ETFs because people are finding out there's no reason for you to actually do a mutual fund anymore. So why change to ETFs? Much lower costs. I mean, the fees are just, you get some ETFs and the fees are, about 0.10 of 1%, very, very low. Tax efficiency, because there's not a lot of trading going on. Some of them are just index tracking, which means they track a whole index. So there's no buying and selling going on inside of them. You can trade them intraday because an ETF stands for exchange traded fund. With an ETF, they trade just like a stock, which means they trade in the middle of the day. So you can buy them in the middle of the day. And because they trade in the middle of the day, just like a stock, there are 0 commissions to buy and 0 commissions to sell. So that's it. There's no front loaded, no back loaded, no 12B1 fees, no advertising fees. None of that exists. They just trade intraday just like a stock does. Buy them, sell them. You can buy and sell in less than 1/3 of a second intraday, just like you'd buy just like any other stock on the stock exchange. Transparency, you know what's in them. Unlike a mutual fund that will only report what's in them on the last week of every quarter. It's the only time they actually have to report what's in the mutual fund. ETFs will let you see what's in them all quarter long. So that nothing's hidden inside of them because they're not traded like a mutual fund is. So you actually get to see what's in each ETF every week of every quarter. So you can actually see, what is my mutual fund manager doing? I don't know. What's my ETF person doing? I can see exactly what's inside the ETF. So much more transparency. And a really cool thing about that, they're optional because they trade on the stock exchange. Most of them have options, which means we can write covered calls on our stock. Can't do it on mutual funds at all. So on a mutual fund, I can't trade in the middle of the day. I do have fees, even though they say there are no fees. The average fee is over 3%. So can't trade in the middle of the day, can trade in the middle of the day. Fees over 3%, average fee less than 0.25%. Trade intraday, trade intraday. I'm sorry, not intraday, intraday. Can't collect a dividend, almost all pay a dividend. Can't write cover calls, can write cover calls. So why would anybody at any point in time say, I'd like to be hindered. I only want to trade at nighttime after the market's already closed to place my trade. So if there's a huge sell-off, I wait for the huge sell-off. I want to make sure that any dividends that are paid don't come to me. They go to somebody else, and I'd like to pay the taxes on those dividends myself. And I'd like to make sure that I can't actually use my mutual funds to write covered calls on. Would that just be crazy to say something like that? Yeah, it'd be just, in real estate market terms, I could like to go ahead and buy a house, but I'd like to buy a house and I'd like it to actually take 6 months to close. And I'd like to be able to have some renters in there, but I'm not going to put any renters in that house. I'm going to leave it empty. And I want to make sure that I at least know the house is doing well. So I'm not going to look at it. So I want someone to drive by my house once a quarter. And if it's still there, I want them to charge me 2% of the net asset value of that home. Does that sound crazy? That's exactly what we're doing with our mutual funds. So the point here is simply this, is let's go ahead and maybe get rid of the mutual funds and try something different. And all of us have access to this. It's not brand new. It's been around for a couple of decades now, and we all have access to it. So death of the human investor, just 10% of trading now is regular stock picking, says JP Morgan, which means that most people are getting themselves into some type of an ETF, which is why we've had meteoric rises on this. The meteoric rise of ETFs is just getting started, says BlackRock CEO. BlackRock is one of the largest fund managers in North America. And he said most of it's just because they have options and hedging strategies built into them, which means that you can actually rent them out and use an option to protect your portfolio if it goes against you. Can't do that at all with a mutual fund. And there's a reason you can't do that, because they don't want you to. They want you just to buy and hold and be confused and be lost, so you don't get it. So you just give somebody else your money so they can use your money for 40 years while you go back to work and use your job to pay your bills. So ETF basics. An ETF is a mutual fund. It's just that it's a mutual fund that trades on the stock exchange. A mutual fund trades on the stock exchange. Similar to a mutual fund, structured like a mutual fund, managed and regulated like a mutual fund. Similar investment groups. There's over 3,500 different ETFs right now, exchange traded funds. But huge differences. They're listed on the exchange, which means they'll trade between 9:30 a.m. and 4 p.m. Eastern. There are 0 commissions. They trade during market hours. Most of them are optionable, which means we can rent them out on a monthly basis. Dividends are paid to the actual holder of the ETF, which means you. And you can place stop loss orders, limit orders. You can sell them short. You can buy them on margin. All things you can't do at all with a mutual fund. So huge, huge bonuses. So anybody that's ever managing your portfolio who put you in a mutual fund isn't doing you a service. They're actually hindering what you can do, and they're charging you extra to hinder you. And the only reason they would do that is they make more money off of it. So we want to go ahead and see how do we get rid of that. So what we're going to do instead is we're going to look at ETFs. You might also hear the term ETN, which stands for an exchange traded note, much like an ETF, but usually they're going to track some type of a commodity like gold, oil, or currency. But since an ETN is backed by a bank, it could go bankrupt. Now the ticker symbol we're going to look at here for gold won't, because it's backed by gold, but some really cool things. As an example, here is gold trading as a futures contract, ticker symbol /GC. So you can trade gold roughly 23.5 hours a day as a futures contract, or you can just buy the ticker symbol GLD, which is the bottom one. And what do you notice about the two charts? They look identical. So if you want to actually buy gold, you can buy bulk gold and walk around with it, put it in your pocket, try to shave off a little bit every time you pay somebody. Or you could just buy the ticker symbol GLD, which tracks the price of gold. It just trades at 1/10 the price of gold. So if gold's at $1,800 an ounce, GLD is at $180 an ounce. Now it's a little bit older chart, but I just put it up here just so you can see it's identical on the charts back and forth. And if you actually want to own gold, the problem with owning gold is what? Anybody know what it is? Go ahead and type it in if you want to. There's a problem with owning gold. What is it? I'll give you a second to type it in using the question and answer section. Tax, okay, yeah, exactly. We could be taxed on it, how it's taxed. Theft of storage, because where do you store it at? You know, you put it in the money, you put it in your backyard someplace and bury it and then get Alzheimer's, and then you got a bunch of holes in your backyard. It's heavy. When you want to return it, you're gonna have to ship it back someplace, you know, get your money out. Can be stolen is good choice. All kinds of drawbacks to gold. Gold has its benefits. It's usually looked at something that we buy when the whole stock market goes to a crash or recession, but it hasn't been that way. Yeah, it's very heavy too. But lately, gold isn't reacting as it normally does. Normally, when the stock market goes down, gold goes up. But both of them are kind of dipping a little bit right now, and they're not heading higher. But gold has typical advantages. But why do I want to own it if I really just want to make some money off of it? So I can just buy the ticker symbol GLD instead. Trades on the stock exchange. I can write covered calls on it. It trades at the 1/10 the exact price. You can see the charts are identical, taking a look at them. So I like it. GLD is a pretty cool item. But because it trades as a stock, I can actually use it as a covered call. So I can actually make money. So as my gold is rising in value, I can actually rent it out. And for those of you who have never done that before, it's just like renting out a house. If you buy an asset, somebody will pay you money to use that asset. Gold is the same thing. If you buy the ticker symbol GLD, somebody will pay you money to use your asset. It's actually kind of cool. So if I just really quickly here, I'll show you what that looks like. Screen share. Oops, screen share here. And let's go screen one. This one, share. All right, hope you can see the screen. Right now I've got OXY up here. Let's type the ticker symbol GLD. And I'll go back and log back in again. GLD. And if I take a look at my screenshot here, you can see that as the market's been dropping so far this year, this is the first part of the year right through here, gold's also been dropping a little bit right in through here. And it's kind of scrolling down a little bit, but you can see it's around $174 an ounce, or $174 per share, or about $1,740 an ounce if you're tracking the price of gold. But because it's trading here at $174 an ounce, or $174 per share, I can go back and take a look at gold. And right now, somebody will actually pay me money to buy my gold. Right now, it's $174 per share. If you own this, somebody will actually pay you about $2.50 a share to buy it from you at $175 next month. So whether it goes up or not, somebody will actually pay you cash. They'll even pay you about $1.65 to buy your gold from you at 177. So if you turn around and you buy gold right now at the current value up here of 174, once you own it, somebody will actually pay you $1.65 to buy it for your 177. Now, that's not what this class is about, but the point is, gold is optional. Somebody will pay you money to use your gold, and if it does go up, they'll buy it at a higher price. Whether it goes up or not, they're still going to pay you about $1.65 a share for every single share you own, just so they can use it for a month. Well, you're just going to sit on it anyway. You're going to buy and hold gold. So want to have someone pay you money every month just to use your gold. Can't do that with a mutual fund. Can't do that with actual gold. But it's pretty cool. And by the way, if you have a price listed, you have a guaranteed person who's willing to pay you money even before you buy gold. They're telling you ahead of time how much they'll pay you to use your gold for the month and to buy it at a higher price of 177.5 in the next 26 days. Pretty cool service. All right, let's go back to where we were just at. Is XLU typically a good ETF for writing cover calls, more of a sideways trend? It can be, Joyce, and we're actually going to look at XLU for utilities. Let's see, where were we at here? All right, so gold, if you wanted to trade oil, you can see that here's the price of a barrel of oil. Come right through when I took this. Obviously, it's a different price now, but just picked it just so you could show the resemblance between the price of a barrel of oil and the price of the ticker symbol USO. And you can actually trade USO as a commodity. So if you want to go for a drive and say, it's going to, excuse me, cost me $100 to fill up your car, just have someone pay you that money, buy the ticker symbol USO, and then write cover calls. And every month you're collecting about $500 a month off your USO, and you just then use that to pay for gas on your car. That's kind of a neat way to go back and do it too. These are things you can't do with a mutual fund. And my point is, if I want to be rich, I got to do the things that rich people do. And average person buys a mutual fund and doesn't even want to learn any of this information. So what are some of the more popular ETFs? And again, an ETF is simply an exchange traded fund. It's a mutual fund that trades right on the stock exchange. That's all that it is. So if I want to see some of the more popular ETFs, I can go over here to the website, top of the page, click under stock scanner, and I go here to ETF scanner, click under where it says popular. And all I'm just going to do is say, what are some of the items that people can use these days to make money versus a mutual fund? Because really, there is no reason for anybody to ever have a mutual fund today. They're old and they're outdated. They still work. It's like having a telephone on the wall in your kitchen with that 20-foot cord that's always tangled. It does still work, but it's limited. A cell phone, no long distance fees on the cell phone. You can use it anywhere you want to go back and travel. You can also get onto the internet. You can take pictures with it, and a myriad of 30, 40, 50, 60 other things that your cell phone will do that the telephone in your kitchen won't. Basic phone call still works, but only if it's local type of item. So the telephone on the wall is like a mutual fund. It's still there. It's just outdated. And anybody that uses a mutual fund isn't using their brokerage account to their fullest capabilities. They're not using any kind of leverage. They're just buying and holding. They're giving their money to somebody else who makes money off of that, and they're paying them a fee for somebody else to use their money and make money off of them. We just need to learn how to do some of that ourselves. Not a lot. I'm not going to teach you a whole bunch tonight. That's going to overwhelm you. I'm going to keep this really simple, but you'll be able to do everything I'm talking about here by the time I'm done with this class tonight. So what do we have here? So some of the more typical ones, if you wanted to trade just the S&P 500 index, right over here on the right-hand side, I can see that it is in a downtrend here for the last 3 months. So here's my chart over here. Over here on the last 3 months, my chart. It's kind of in a downtrend because the whole market's been heading lower. And it's trading right now, right up through here. And you can see right down below that, about $46 a share is the ticker symbol SPLG. It's the same thing as the S&P 500 ticker symbol SPY. It just trades at a fraction of the price. So if you wanted to say, I'm going to get rid of every one of my mutual funds and just buy the ticker symbol SPLG, you could, because you have all 500 shares of the biggest companies in North America in one ticker symbol from all different sectors of the marketplace. Now, even though the markets are down on this one here, just a little over 20%, the average mutual fund currently is right now down about 24% because of all of the fees. So even though you're down 20%, you're not down 24%. So if the overall markets are up 15%, you might be up 18, 19, or even 20% without the fees. So you're always going to do slightly better than what the mutual fund managers, the professionals, are doing, because all of the different fees are gone and the dividends that you get to keep on top of that. I can scroll down. They have inverse funds, which is really kind of cool. So in other words, whenever the S&P 500 index, which is the benchmark for the marketplace, starts to drop, as an investor, your mutual fund manager is kind of scary, but your mutual fund manager by law isn't allowed to liquidate all of your mutual funds. They just can't do that. And here's what's happening. Mutual funds, and there are over 30,000 of them, are huge. They control the marketplace. There's over 60,000 institutional money managers in the US. When you add hedge funds, pension funds, insurance companies, mutual funds, and investment banks, there's over 60,000. 30,000 alone are mutual funds. Now, by law, mutual funds are not allowed to sell the majority of their holdings in any situation whatsoever, because they're so big and they control so much of the market. If they actually liquidated, it would just crush our economy. So they're just not allowed to do that. So when the whole markets are dropping and you have a mutual fund, those mutual funds are required by law to keep the stocks that are in there, and they have to own them as they're dropping in value. That's kind of scary. Well, you don't have to do that if you own an ETF. You can just get rid of it and sell it at a second's notice whenever you want to, just because you can. You can't do that with your mutual funds. Now, because of that, the ETF community creates something called an inverse fund that works completely backwards. So whenever you see the S&P 500 dropping like this, we see the ticker symbol SDS increasing in value. It's just a mirrored image back way. So if I type up the ticker symbol SPY on our site, and I'm just going to go back now and add a second chart to this. So I'm going to go back and do SDS, which is the inverse fund, and then click go. And what you'll see now are two different charts. So the top one over here is SDS, and you can see which way it's trading. And the bottom one over here is SPY. So whenever SPY was dropping, right through here dropping, SDS was going higher. And whenever SPY was increasing, SDS was dropping. So it's just a complete mirrored image. So if I pull over here now a 6-month chart, that's what they look like on a 6-month chart. So whenever the S&P 500 looks bad and our economy looks bad and inflation is bad and the Fed's raising interest rates and tightening the monetary supply policy and everything looks negative for our economy still for probably the next 3 months or so, why do I want to continue to own anything that's dropping in value? Why can't I just buy the ticker symbols that are going up like SDS? Complete mirrored images. Can't do that with your mutual funds. ETFs, you can. Ticker symbol here is Sam David Sam. And Sam David Sam is the ticker symbol for the S&P 500, but it's the inverse fund, so it works backwards for us. Kind of cool. I know I'm giving you a lot of information here, so you can go back and watch us over and over again. I know that Protect Wealth YouTube account, you can kind of watch this video over and over again. And I do talk fast, I get that. So if you have a question, ask it now. Otherwise, by the time you thinking about the question, I might be 2 topics ahead kind of going forward. Where we're at. So hopefully we're back on this one here. Good. All right. So some of the popular ETFs, there's lots of them out there. There's ETFs that track gold. There's ETF that tracks oil. There's ETFs that track currency. There's ETF for different sectors of the overall marketplace. So you can find out kind of which ones actually look the best. If I go back right now, and let's go back to the website. This one here. and I click under stock scanner and just go back to the popular ETFs and scroll down the page a little bit. All you have to do is just kind of scroll down the page and see which of these are actually in an uptrend. This is a 3-month chart to the right. So just scroll down the page and just look for one of the charts that doesn't look bad that you say, I like that trend. And we are here. Here's XLE, which is energy. Well, how does this one here look? So let's go back and click on the ticker symbol, oils and energy. Here's a 6-month chart of oils and energy. Whole stock market's down, but how's oils and energy look? Are we in this ETF? We should be, because it's in an uptrend and it looks really positive right now. I'll show you how to read charts here in just a little bit, but basically we read a chart where you start here on the far left-hand side. This is a 6-month chart. And over here on the far right-hand side is today's chart or today's price. So if I go through here and draw, so this over here would be 6 months ago. Here is today's price over here. Just draw a straight line between the two. And how's that trend look? It looks fantastic. These are things that we should be taking a look at. Whenever the stock market's dropping, there's always going to be a sector of the marketplace that heads higher. Right now, it's oils and energy. So if I am trading ETFs and I don't have mutual funds, I'm not going to go back and buy and sell every single day. But this is a 6-month chart. It's been in a nice uptrend for 6 months. So I like something like this. So if I'm thinking about buying, what I want to hold on to a mutual fund, if I could just go ahead and sell my mutual funds intraday like an ETF and turn out and buy something like this. If I look at my charts over here, they still look pretty positive. I got a green arrow, which is a buy, a green arrow, which is a buy, and a green arrow, which is a buy. And I have an uptrend with 3 green arrows saying buy, buy, buy. And this thing is heading higher, buy, buy, buy. How can I avoid a huge tax expense? Good question. If I take my money away from the financial advisor and trade it in the marketplace on my own, really good question. So the answer to that, Robert, would simply be, is it in an IRA or a Roth or any type of retirement account? And the answer would be no tax consequences on it. And the second one might be, well, if you take a look at what it looks like today versus what it looked like, 6 months ago, if it's in an IRA, there's going to be 0 tax consequences because everything inside the IRA is tax deferred. And so you don't have tax consequences with inside of an IRA. They don't exist until you start taking the money out, and then you're just taxed at whatever the rate is. So there's no tax on capital gains inside your IRA. So you don't have to worry about that. If it wasn't in an IRA, probably now would be a fantastic time to do it because most of your accounts are probably down about 25% year to date. And that would be the time to take some of those, sell some of those items. So you don't have to worry about any capital gains taxes inside of a personal account. But inside your IRA, you have to worry about it all. The capital gains don't exist inside your IRA. So you can just go to them, and it was a good question. Anytime you go to your financial advisor and say, I want to start to manage some of my own money, and I'm going to show you really how simple it is here in just a few more minutes. When you say that, they're going to say, oh, you don't want to do that because, and they're going to throw out all kinds of jargon, all kinds of lingo, things that they've learned in the past to tell you how bright they are, how smart they are, why you don't want to go back and do it because you can't do this, you're not smart enough to do this, because you have to have a job and you have to use your job to pay your bills so you can continue to give them money every month so they can live off your money. And basically, what you're doing is saying, I'm canceling my sales contract with you. And what's every good salesperson going to say when you do that? Oh, you don't want to do that because. And in reality, most of them don't actually know how to invest. And I know that sounds kind of strange, but in order to become a licensed financial advisor in North America or a licensed broker, you don't have to know anything at all about how to invest. Every question except for one is all about what is legal and not legal to do with your clients. And I know because I've taken all the tests. And our company, we manage money as well. That's not what this is about here. I'm trying to teach you to do it yourself and let you know that what else somebody is doing isn't that difficult. I'm going to show you exactly what it is they do. I have all kinds of people come to my classes that are actually in the field who are licensed. And the reason they come to my classes and take the classes is because they're not taught any of this information and they want to go back and learn it. So if we go back, let me erase that where we had here and annotate. Here we go. And stamp, erase, undo. There we go. Okay, so now the point is, if we're going to be doing something, I want you guys to learn how to do it yourself. It's a very simple process. You're going to spend maybe an hour a week at the absolute most doing this, about an hour a week. But I'm going to show you how much it's going to go back and save you money-wise. Okay, share back to our website. So talked about ETFs. What an ETF is, it's just a mutual fund that trades on the stock exchange. That's all that it is. Finding them is very easy. I'm going to show you exactly where you're going to go to look for them. But once we're going to decide we're going to buy an ETF, I want you to also pick an ETF that pays a cash dividend, an ETF that pays a cash dividend. So on our cash dividend, I get rid of my marker here. Draw. Mouse. Okay. So I want ETF pays a cash dividend, and all dividend is just money that a company goes back and pays you. It's not difficult to get them. The reason a company pays a dividend is that they make a bunch of money. Back in the old days, when you wanted to go back and do some research and try to find out what's a good quality stock, they didn't have online brokerages, they didn't have any technology, they didn't have CNBC or Fox Business News. So if you wanted to find out if a stock was actually a good company to buy, what most people did back in the early 20s, 30s, and 40s, they looked to see how much company paid as a cash dividend. And all a cash dividend is money a company pays to you after they make a profit. So let's say we take a look at a stock like Coca-Cola, ticker symbol KO. Big company, not just nationwide, but worldwide. I mean, where is it that they're not selling Coke? In fact, they have it so many places that they had to go back and say, we can't expand anymore. So let's go ahead and create the bottled water industry, which they did. And let's convince people you can't even leave your house unless you have a bottle of water in your hand so that you don't dehydrate and melt before you get to your car. And so then they started selling bottles of water for more than they sell for Coca-Cola. And so that's how they started to make their money. But nowadays, where else are they going to go? Everybody's got bottled water, or they've got some type of water in a cup. And they've got Coca-Cola, so what are they going to do now? They're still big, they're still making money, but they can't use their money to expand and grow. So what they do instead is they say, we're just going to give some of that cash back to the investors as a cash dividend. So when they make a profit, instead of using some of that profit to grow the company to a bigger company, they take that money and say, we're just going to give it back to shareholders. And all you have to do to get a cash dividend is buy a share of that stock. If you buy a share of stock that pays a cash dividend, every 3 months, you automatically just get a cash payment. It'll either come to you as a check or be redeposited into your brokerage account. The first time you buy a stock that you own that pays a cash dividend, your broker will ask you, how do you want to take the money? Do you want it to be redeposited in the account so you can use it, or do you want them to mail you a check for cash? It's your choice. So in the old days, people just looked for companies that paid a cash dividend that had been paying for years and years and years. Because if you had a company that paid a cash dividend because you made a lot of profits and you've been paying that profit year after year after year, you must be a profitable company that's got lots of cash. And so that's what people did to actually evaluate which company they wanted to buy back in the 20s, 30s, and 40s. Nowadays, it's much easier. So all a cash dividend is just money that comes to you as a shareholder because you bought a share of the stock. Usually these are paid out every 3 months, and that comes out right after earnings come out on a company, right after earnings come out. So if I wanted to go back and take a look, for instance, at Coca-Cola for a dividend, I can come back to the website. I can type in the ticker symbol here, which is just KO for Coca-Cola. And then from here, I will scroll down and I will click where it says company, right in the middle of the page. And under company, I will scroll down where it says key ratios, and a dividend is a ratio. What's the yield ratio? So I'll scroll down the page and it just tells me the annual dividend right now. I'm taking a look at this. Coca-Cola pays 2.74% on your money, 2.74% on your money. That's the annual yield. So in other words, for every share of stock you buy, you'll make 2.7% per year on your money. If Coca-Cola doesn't even move a penny, you'll make 2.74% a year on your money because of the cash they pay you. So your profit or your rate of return is just profit divided by investment. So if you're making 2.74% of your money and Coca-Cola doesn't even move a penny, that's pretty decent. But if Coca-Cola also goes up 5% a year, you're actually making 7.7% a year on your money. And so it tells you when it's paid out. The next dividend over here, we take a look at here, it says X dividend date. Coca-Cola is going to pay the dividend right after June 14th. X dividend date simply means if you buy the stock on or after this date, you won't get the dividend for the previous quarter. Because all stocks pay a dividend every 3 months. When they pay dividends every 3 months. And so this one here pays a dividend after June 14th. So if you buy the stock, so the dividend will probably, the cash will probably come to you June 28th, June 29th, just a little bit after that. What this is saying is if you buy the stock before June 14th, like on June 13th, you'll get, if you only buy the stock on June 13th and sell it for June 14th, you only have it for 1 day, you'll get the dividend for the entire 3-month quarter before that. But you got to buy it before June 14th. And so that's called the X dividend date. If you buy on or after this date, you're excluded from the dividend for the last 3 months. But if you buy it on June 14th and you keep it for 3 months, you'll get the dividend for those 3 months as well. So dividend, most stocks on the S&P 500 all pay a dividend. So if you're interested in collecting dividends, it's a great way to collect some money. So if I'm now going to go back and buy an ETF, I want to buy an ETF that actually pays me also a cash dividend, because now I'm making money twice. I'm buying an ETF, which means I'm diversified, but I'm buying it. I'll get money. If it goes up, that's growth, but I'm also going to collect a dividend on that same money. So I'm now making money twice versus just once. That's kind of a bonus. So money twice at the same time. Joyce, in an IRA account, TD Ameritrade, will dividends automatically be reinvested or placed back in the IRA account, or do you still need to specify? If you haven't already specified once, then you'll still need to go back and specify. But usually inside the IRA, it's always going to come to you. I'm sorry, I said that wrong. Inside the IRA, it's always going to be deposited, just so that you don't have the tax consequences if it comes out of it. Because anything comes out of that IRA is going to be taxed on it. So typically inside the IRA, it will be redeposited. Outside of an IRA or a Roth account, it will ask you which one that you want. Do you want to collect it, or do you want to be redeposited? Oops. Where do we go there? Lost my questions. Okay. Where are we at here? I think we're down here someplace. Bonuses. Okay, we're back on our dividends. So make sure we got the right screen up in front of us here. Screen. This one. Good. Okay. So paid out usually on a quarterly basis on those. Here's a quote from Susie Orman. I've been telling you now for 2 years to get into safe, high yield, dividend paying stocks or ETFs. Nowhere on here does she say buy mutual funds. Here she is again. If you're thinking about investing today, I recommend considering dividend paying stocks. Does a dividend paying ETF such as XYLD or RYLD meet your criteria? We'll take a look at that, Susan, when I go back into the charts next time. So let's make sure we don't delete that question so I can look at it again. Does holding your stock dividends mitigate your taxes if you hold longer than a year like real estate? It does, because you're going to long-term capital gains at that point, unless it's in an IRA or Roth where it doesn't matter. Okay, here's Warren Buffett. We all know who he is. So Warren Buffett, his 5 largest holdings in his entire portfolio are Bank of America, Apple, Coca-Cola, Kraft Heinz, and OXY Petroleum, Occidental Petroleum. It's 5 largest holdings. As of second quarter, as of 2012, that's 2022. Make sure I get that correct. Second quarter 2022. So here's his 5 largest holdings. You know what's similar about all 5 of those? All 5 of his largest holdings, 63% of the entire portfolio, all 5 pay cash dividend. Interesting. So if all these well-known investors are doing them and talking about them and saying we should get into some ETFs that pay dividend, we should at least say, maybe I should not be in mutual funds anymore, because the only person who's actually saying mutual funds is the person who wants me to give them my money for the next 30 or 40 years. Everybody else is saying, don't do that, because that's not rich people do. So if I wanted to go back and do any of those, I can go back and just say, how much is any stock I want, or how much does it pay a dividend? We've also got some really great dividend searches on the website, which if I wanted to go back, I can just click under the stock scanner and I can come down to best dividend stocks in the entire stock market, dividend searches, and they'll be ranked for me. And I can just go back and see which stocks are actually paying a high dividend. If I go here on the website, I'm on the dividend search here under stock scanner and click under dividend searches. And so every single stock now that pays a cash dividend is going to pop up. One that pays the most, come right here across the top. Starbuck Care at SBLK, ticker symbol SBLK, pays a dividend, undervalued, and a nice uptrend. And I can just kind of scroll down the list here and see which ones pay the highest dividends and kind of scroll down. Do I like any of them? Now let me just see if I can find a quick one here that kind of fits our criteria. Go down to the next page. They're ranked from the highest dividend to the lowest dividend. And I can see here's right through here, Genco Shipping and Trading, ticker symbol GNK, pays a yearly dividend of 14%. So if you buy the stock, it pays a dividend of about 14%. It's also an undervalued stock. It should be worth about $42 a share, and it's currently only trading here at about $34 a share right now. So now I've got a stock that's kind of moving sideways, just starting to bounce a little bit last couple of days, undervalued, pays a nice cash dividend, 14% a year. Even stock doesn't move a penny, it still pays 14% a year. So I can just kind of scroll down, see if there's anything else out here I like. There's a stock kind of moving slightly sideways, but the whole market's been down, but the stock is moving slightly sideways. Ticker symbol EGLE, Edward, Greg, Larry, India, EGLE. Here's a 3-month chart. It's undervalued. It should be worth about $127 a share. Think of this as the fair value or the short sell value for a house. If you could buy a house at or below that price, you got a good deal. So think it's a short sell value. And this thing here now is selling for about, is that $68 a share? Yeah, and currently it's starting to move, excuse me, slightly sideways. So I got an overall uptrend on the stock for the last 6 months. It's currently moving slightly sideways. Good looking stock. All of it looks great. Fundamentally, it's a good stock. These are things we just haven't really talked about yet. But the point is, it isn't difficult to make money if I kind of follow the rules here. So I'm trying to find things that pay a nice cash dividend other than just buying a stock. I can just buy a stock if I wanted to, or buy a mutual fund, but I want to be able to buy an ETF that pays a cash dividend so I make money twice that I can also use for other purposes. But the point is, do I do the things that average people do? Hey, here's my money, Mr. Mutual Fund Manager. Take it for the next 40 years. And hopefully, based off of what you've taken away in fees for managing the money and fees for the actual mutual fund itself, it will be less than whatever my mutual fund goes up every year. And I'll be okay in 40 years. And you're just kind of hoping that it works out. And that's not really one of the best strategies for us. Not really the best strategy. So what are we going to do instead? Instead, we're going to change this. And here's what we're going to do right now. So now I want you to start taking some good notes, because right now I've just been talking about different items. We're going to start to put it all together. And this is what you're going to be able to do yourself. So instead of actually turning your money over to a money manager to go back and do all of this work for you, you'll be able to do everything that they do in less than 1 hour. That's it. It's a very simple process. Here's where else. So start taking some notes. Step one, I'm going to go over to our website. I'm going to click over here. It says asset allocation. ZIM is paying $2.85 dividend on May 27th. Yeah, we like that too, huh? Asset allocation. Now, when you walk into, and here's where I learned this. My sister used to be a broker in Beverly Hills, and so this is where I learned this process. When I took my tests for money management, there's only one question on how to manage a fund or how to manage anything, make money in the stock market. Only one question, really basic question. And really what it boiled down to was a basic question that just showed how you couldn't be sued if you were a broker. But here's what we're after. You walk into any kind of a bank and say, I'd like to open up a mutual fund. As an example, I was transferring some money the other day. I was buying some real estate. I sat down at the bank. I wanted to wire some funds. And the gentleman at the branch office there, where I was wiring some funds, looked at the name of my company, Stock Market Education. He said, oh, you're in the stock market, huh? And I said, yep. And he said, I'm the guy here at the bank that, he had a title. But I'm the person here at the bank that if you want to actually open up any brokerage accounts, retirement accounts, come see me. I'll be happy to help you out. And I said, well, great. And he said, I've been here now for about 6 months. I just recently got hired here with the bank. I passed all my tests. And so any questions you have, or you want to do that? And I said, well, great. So I said that you must be watching, and I gave him the ticker. I gave him the ticker symbol for Wells Fargo, WFC, Wells Fargo Corporation. And it was Wells Fargo Bank. And I said, so great, you must be watching WFC then. And he just looked at me with the big blank eyes, and he had no idea what I just said to him. And this was the person, when you walk into the bank to open up an account, who's going to put you in mutual funds to manage your funds for the rest of your life. This is the person you sit down and talk to. So when I said you must be watching WFC, which is the ticker symbol for the bank that he worked at, Wells Fargo Corporation, he had no idea what I just said to him. And tell me that's not scary, right? This is why you want to do this yourself and how you can do it. So when you walk in, the first thing they're going to ask you is, how old are you? And the reason they ask you that, I'm just going to type up 45 for this presentation. The reason they ask you that is to find out how old you are, to find out if you got a long ways till you're going to retire, or you're going to retire shortly, because that's going to change what percentage of your money is going to go into stocks versus bonds. So you're going to say 45. And the next question, what age do you want to retire? Maybe 65 years old. And it'll say, do you want to have an aggressive or conservative portfolio? Well, I got 20 years left, so I'm going to go aggressive. Generally, when you're within 5 years of retirement, you want to stop being aggressive and go a little bit more conservative. And then it says, what's the current value of your portfolio right now? So what's inside of your IRA or 401k or Roth? And hopefully about that age, you should have at least $75,000 about that age. So I'm just going to put in 75,000. More is even better, but let's not make it look too great. So let's put in 75, 750, 7,500. There we go, 7,000, 75,000. Okay. Now, do you want to add additional funds to your account? Do you want to add extra money to your account? I'm going to say no. Let's just see what's going to happen. Now, if I start with $75,000 and give it to a portfolio money manager to manage this, on average, based on the breakdown, they're going to say you should have about 44% of your portfolio, or $33,000, into equity mutual funds. That's what they're going to tell you, which are just stock mutual funds that hold stock. That's what that is. And you should have about, to diversify, about 21% of your portfolio, or $15,000, should be in international equity funds. And you should have about $5,250 into bond funds. And you should have about 13,500, 18% of your portfolio in income funds, 10% into REITs, which are real estate investment trusts, funds that own real estate, and zero in cash at this point. Now, if you scroll down, and this is based off of how old you are, and the percentages based off of your age, and they have the exact same spreadsheets at the bank. So now this will go down, and it'll tell you on each age, based on how old you are, about how much money should be in your account when you're 47, when you're 48, how much money should be inside your account. And it tells you age by age, based off of your portfolio breakdown, how much money is in your account. Now, we're going to change this once a year based on how old you are. We'll come down and run the same numbers, and it's going to reevaluate your portfolio and say where the money should be. But if I scroll all the way down here to the very bottom, by the time I'm 65 years old and ready to retire, I should have about $244,000 in my portfolio to retire. So now I know that if I actually do this and I put this money in, this is just going back and use historical averages for the bond market, the international markets, the real estate market, the equities market, just historical averages. Same thing, all the banks use, exact same formulas. I should have about $244,000 to retire. So now you know how much money you're going to retire off of. And so you say to yourself, is that going to be enough? And if the answer is no, then you got to scroll back up to the top of the page and kind of start to figure this out. Well, I can't really change how old I am. I can change when I'm going to retire. Maybe I can change it to 67, 8, 9, but obviously I'm not going to be going backwards. I can't change the $75,000 I have. So maybe now I have to maybe add about $300 extra per month, every month in my portfolio. Just like if you had a 401k, you're taking money out of each paycheck. So if I add an extra $300 a month, let's see what my breakdown now comes to. The percentages don't change, right? Percentages don't change. But now, if I scroll down to the bottom, my portfolio is going to be, instead of 244, it's going to be $381,000. Wow. Are you going to get to your goal? Probably not. What are you going to have to do now? Maybe I need to add about $500. So you can just kind of start to play around and kind of work with how much money do you want when you retire? Well, I'd like to have enough to actually retire. So let's calculate my breakdown again. Scroll down to the bottom. And now I should have about almost $500,000 to retire. So now I'm getting a little bit closer. So I'd say, okay, I got about $500,000 that I might be able to go back and retire with now. So that seems to be okay, but here's the kicker. That $500,000 is if you do this yourself. If they take only a 1% management fee away from this, your $472,000 is now $384,000. So if your money manager, the person managing your account, charges you 1% of your portfolio value, which is less than normal. Normal is 2% in this industry. But if they only charge you 1%, your portfolio now, instead of being $472,000 to retire, will be $384,000. So if you don't do what I'm about to show you and you say, I'm busy, I have a job, let somebody else do that, they're going to make $100,000 off of you. That's $100,000 you will not have in retirement because you're too busy to. You're too busy at work helping somebody else build their business so that you don't have time to build your third part of your life, which is your retirement. So let's say, how do we build that life, third primary retirement? So now I don't want to give that money away. I want to keep it. Let's get rid of that guy. I want to keep the whole 472. So I'm not going to have somebody manage that money. I'm going to do it myself. Now, I'm not saying you can't have somebody manage your money. If you say, I've just got no aptitude for the stock market and don't want to do this for whatever reason, then go ahead and hire someone to do it, but make sure they're good at what they do and don't just give it to the average money manager or mutual fund manager. So now, if I'm supposed to have about $33,000, 44% of my portfolio in equity ETFs, wouldn't it be just really cool if somebody who actually understands investing would create a website and just have a link and show me what are some of the best equity ETFs out there? Yeah, Mike, does this apply to life insurance and annuities? With life insurance and annuities, sort of. If your money manager also sells life insurances and annuities, you should leave your money manager. Because what they really do is they sell high commission products. So if they sell high commission products, what do you think you're going to get put into? You're going to get put into mutual funds. So if your money manager sells life insurance and annuities, both of those are very, very high commission items. You need to get rid of them just for the stock market. I'm not saying you don't need life insurance or annuities, but you don't want that person to have your brokerage account as well, because they're going to do everything they can to make additional money off of you. Annuities, by the way, great item, but they are the #1 commission item for anybody in the financial markets. You make more money selling annuity than anything else. Those are why people sell them. So I should have about 33,000. Good question, though. I appreciate the questions. I should have about 33,000. So all I want to do now is to find out 33,000. I'm just going to go back over and I'm just going to pull up on the website here, stock scanner. And if I'm supposed to have about $33,000 here into equity ETFs, so go back onto our website here, and under stock scanner, I'm going to click under equity ETFs, and that's going to come a list of all the equity ETFs in the marketplace. So now these are just like mutual funds; they just happen to trade like a stock and are optionable. So I'm just going to scroll down the list, and I'm going to avoid right now the first one because this is an inverse fund at the moment, just so we can kind of see the process. And I'm going to scroll down until I actually find what I like. And all I'm going to do is I'm going to look at the right-hand side of the page. So this one here, XLF, which is the finance sector of the marketplace, ETF. Go down, and I see the first one here, XLE. This is energy, XLE. I like XLE. It looks good. This one here is now in a nice uptrend. So if I take a look at this chart, XLE, I can click on it. How's that chart look? And I know a lot of people tell me, yeah, Mike, I don't know if I like that chart because that chart right now is currently high. It's way too high for me to go back and buy. And I say, okay, I understand that. So let's just go back now and see if we see this. How about this? I sure wouldn't buy that stock now because look at that stock. That stock's way too high. Oh man, I definitely wouldn't buy it now because it's way too high right now. Man, I sure wish I would have bought it over here when it was low. Oh, back when it was low, you thought it was high. Then we go across a little bit further. So, oh no, look at the stock now. Whoops, it's way too high now. I sure wouldn't buy it now because look how high it is now. I definitely wouldn't buy it high. It's way too high. But man, I wish I would have bought it back here when it was low, right? There's no high, there is no low in the stock market. There's overvalued and there's average and there's undervalued. But there's no low and high in the stock market. That part doesn't exist for us. So now, if I come back over here, so I like XLE. So I should have in my portfolio about $33,000 invested in XLE. Well, if this is right now at about an $84 stock, how many shares of stock can I buy in XLE? So just pull out your calculator and you're just going to go back and divide $33,000 divided by $84 a share, and we can buy roughly 392 shares of this item. So I'm just going to make it 400 to make it pretty easy. So we're going to go back and say, I'm going to go back now and buy 400 shares of XLE. So I'm going to type that on a Word document. I'll come back to it here in just a second. And say, okay, I get that. That makes sense. So right now, I've already picked my first fund that I'm going to buy to do this in my entire portfolio. So we go back now and say, okay, what was next? Well, I now need to have about $15,750, about 21% of my portfolio should be in the international markets. So I can click right here where it says, click to see a list of good international markets. I just don't want to leave the page. So I'm just going to open up the second page over here that I have open. So I got 2 pages open. Click under stock scanner, go down to the ETFs and click under international equity ETFs. And up comes a list of all of the really good international equity ETFs. So now I'm just going to kind of scroll down the page and see if there's anything on here that I might like. I'm really just looking over here at the right-hand side of the page. And by the way, this column right here, this is the dividend, how much the stock actually pays in the form of a dividend. So it tells you the dividend. So I can kind of scroll down, see if there's anything on here that I might like. Here's EWP. Here's a Spain. Spain looks okay. Not too bad over here on Spain. Here's Japan, Wisdom Tree Japan hedge fund. So Japan, and Japan pays a dividend of 4% a year extra on this one. I like that one. Would I, Jason, good question. Would I ever recommend dollar cost averaging? Not so necessary when you're doing something like this. I don't generally dollar cost average. If I see something that drops, and I'll just kind of let it go for the reason I bought it, and I might go back, and if I still like it, I might buy it, but I might also see if instead of dollar cost averaging, if there's something else I might like more versus dollar cost averaging. How would I get someone off the no load Vanguard index funds? Good question, Jason. How do you get someone off of those? They say no load, but they're not no fee. No load just means that there's no front load. You don't have to actually pay to buy into them, but they still have fees, and the fees are over 3%. And that comes right from Morningstar.com. So if you actually look at the fees, not the load, but the fees, somebody still has to pay that. The mutual fund's not free. Somebody's paying for all those different fees, and it's you because you're the actual shareholder off that. So how do you get someone off of those? Simple part is just go back to your brokerage firm, and if somebody else is managing your money, what you have to say is you have to actually tell them, I want this now to be managed by yourself. So you're saying that I don't want this to be managed anymore. So I want this to be an unmanaged fund. And they'll let you do that. They won't like you do that. Yeah, this will go on YouTube, and thank you. But they'll try to talk you out of it. Just understand, because you're taking their money away from them, and they don't want that to actually happen. But the goal is here, there's just no reason for them anymore. There's no professionals that I know that actually use mutual funds. All of them use ETFs these days. And even Warren Buffett and Susie Orman, they're all talking about the same thing. Get rid of your mutual funds, get into ETFs. So that anybody puts you in the mutual funds, they're after a reason for it. They're trying to get some money. And it's not wrong. I'm not going to say that that's wrong. If you're not going to do anything at all, mutual funds better than nothing. It's just that get rid of that telephone on the wall in the kitchen and get yourself a cell phone. Things have changed. Technology's come back and changed. So I like the Japan. So I like this right here. It's DXJ is the ticker symbol. So DXJ is kind of in an overall sideways trend. It's kind of moving sideways, but it pays 4% a year. Where the whole market down right now is down over 20%. This is just moving sideways. You're diversified. You have the biggest companies in Japan in one ticker symbol. The ticker symbol is DXJ, and that ticker symbol pays 4% a year just for owning it. So if you buy it, do nothing else, you'll make a little over 4% a year just in the dividend alone. So we should have it right here about $15,750 for this one. So I'm going to open back up my calculator, and if I've got 15,750 divided by the current price of this, which is about $63 a share, I should buy about 250 shares of this. So let's go through here on DXJ. I'm going to go back now. I need to buy 250 shares. So what I'm doing right now is I'm diversifying my portfolio the exact same way the bank would use it, the exact same algorithms the banks use. But what I'm doing instead of giving it to them and say, you tell me what to put me in, and where they charge me that extra $100,000 a year or $100,000 on my portfolio by the time I retire, that's on a $75,000 account. What if you had a $500,000 account? How much money are they taking off of that? Holy moly. In fact, let's just go back and see that, because that's a little bit scary. Let's go back here to where we're at here on all of our different, how much we're breaking down. What if we actually had a little bit larger portfolio instead of 75,000? Okay, let's see if we had, let's say $400,000 in our account already. How much is this going to break down to now? Calculate my breakdown. When I retire, using this information, I should have about $1.5 million in my account if I do this myself. But if I had somebody else do this, I'm going to have 1.1. They're going to take over 400. Holy crap. They're going to take over $400,000 to do this themselves. When I hear people say, Mike, I'm kind of busy with my job, I don't have time to do this. Well, that's great. Pay somebody else $400,000 of your retirement. I mean, how much longer could you live on an extra $400,000? Yeah. Well, you just see the TJX screen. That's all that we're after here. So I kind of went back to, make sure I'm on the right one here. This one right through here, share. So I went back over here and I just said, typed up on the very top, what if we didn't have 75,000? And what if we actually had $400,000 instead of 75,000? And I hit my calculate breakdown button, went down to the bottom of the screen, and it said right now we're going to have about $1.5 million to retire on. But if we have a money manager only charges 1%, my $1.5 million is now $1.1 million. They're going to take almost $400,000 to do this. Now, you only have to do this once a year. That's it. That's all they do with your account. They do it once a year. You do what I'm about to do once a year, and you walk away. Now, I'm going to show you a little bit safer trip than that, but you do the same thing they do. They walk away, and yet you still pay them a percentage of your entire portfolio every quarter, and they have to let it drop when the markets drop because they're not allowed to exit everything. They're just not allowed to. So that's kind of scary. So now, if I go back, let's go back to our screen, make sure we're on the right one so you can kind of see what we're doing. Go back here. And so now, we were supposed to have about, on income funds, $1,350 on our income funds. So I'm just going to go back up here to the stock scanner, scroll down the page to where it says income funds, right here, income funds, click on it. And now just kind of scroll down the page until I find something that I like, anywhere across here. And I'm just looking at the right-hand side of this over here. These ones here pay, these are all income funds. These are funds that are ETFs that pay high dividends. That's what we're looking at right now. So I don't really care how high the dividend is if it's in a downtrend. So I want one that's kind of holding up very well here. And that's what I'm after. You can see DVY looks okay, kind of head sideways, 3% a year. Just kind of go down, HTV. I like this one here, HTV, kind of moving sideways through here. Good looking fund. Pays 3.5% a year interest if I buy it right now. So about $100 a share, a little over $100 a share. I'm supposed to have about $13,500 in here, so I can maybe buy 10 shares on this one would be okay. and 12 shares, 13 shares. And we buy this one over here. So then we come out here, we buy about 13 shares over here, and over and over and over. And by the time I'm done, and I'm just going to kind of pull this up for us now, share my screen. Let's go Word document. By the time I'm done, kind of got this right here. We've got our money should be on our equity. Let me make this bigger so it's easier to see because I'm older and sometimes it's a little easier for us to see bigger items. Now, this is exactly what's happening when you go to your bank. They're doing this exact same thing. Equity, $33,000. We're going to buy about 400 shares of XLE. International equity funds, 15,750. So we're buying 250 shares of DJX. Bond funds. I just did this before class. Take a look at it. Income funds. We just looked at this one here. Income funds, $13,500. Ticker symbol HDV. We should have about 13 shares of that one. And we just kind of go back and look over and over and over. I'm sorry, we should have about 130 shares of this one here. 130 shares. REITs. Kind of go back and take a look at REITs, but there weren't any good REITs when I was looking at this. So we just stay out. We don't put that $7,500 into work. We just don't use it. And now you do this once, and your same exact thing your portfolio money managers do, but they're going to charge you $100,000 once a year to do this. We don't have to do this once a year. That's all that they do it. And then usually once a year, they say, why don't you come back in? We'll take a look at your portfolio. I really care about you. I want to see you face to face because I want you to like me. And I want to go ahead and rebalance your portfolio, which means they're going to get paid more, by the way, and see if we need to sell any of the things we have and buy something else. And so you go back to your brokerage account and now you just buy these, whether you trade online or just call up your broker on the telephone and say, I want to buy 400 shares of XLE. I want to buy 250 shares of DJX. And then you keep them. Now, what's even better though, is we're going to come back to our website now. Oops. And my computer is kind of freaking out here a little bit. I'm going to come back to the website, come back over through here, make sure we're still here. And now, over here where it says watch list, I'm going to click on my watch list over here in the top left-hand corner. And I'm just going to type in those ticker symbols to make this really, I'm almost done, guys. So stay good. This is what you have to do once a year. And it's going to take you all of about an hour from beginning to end, and you're pretty much done. It says now, type in your ticker symbols. So our first one here was just XLE, was a ticker symbol. It was the first one. We're going to buy 400 shares. You're going to go to your brokerage firm and buy that. Then you're just going to hang on to it. Now, if you know, and it's going to pay you a cash dividend as well, you get the cash for free. You don't have to do a single thing. It just comes to you in the cash dividend. But if you had to write covered calls on it, which means someone pays you money to use it, you're going to make even more money. So now we come down, and here's our stock XLE right through here. You can kind of see it looks kind of nice on the stock right here, XLE. Now, if it ever comes down and drops beneath one of these red lines, that's called a floor, a support level. If it ever starts to drop beneath those, it's now heading lower, and it's going to start moving into a downtrend. So what you do is you click right here where it says SMS alert and email alert. And now, as soon as your stock, whether it's a week, a month, 5 months, 8 months from now, if it ever starts to come down and drop and start to make some lower lows, which means it's changing its direction, it should go up, it should pull back, it should go sideways. But if it pulls back too much and starts making lower lows, you're going to get an immediate text from us. You're going to get a text from us right in through here, and an email alert saying, hey, here's what's happening in your account. The stock you have, XLE, is starting to change direction and it's starting to drop. And so now you can go back into your account and decide if you want to go back and just sell that item. So it sends out that text, SMS text. And so anytime it gives you a lower low and starts falling off, we get an automatic alert. You don't have to do, your broker won't do this for you, but now we will, and just let it sit there. So you can type in your 5 different ticker symbols. The other one we had here was DXJ. So just go back here to DXJ, type that one in. Now you can also go back if you want, and you can put down some notes right in through here. Notes, I'm buying this, buying 400, whoops. Notes, buying shares for 33% of my portfolio. And then you just click on save. And now you have some notes like, why did you buy it? What was the reason you kind of get in there for? Makes it nice and easy. And just put all your different ticker symbols in. Do the same thing now for DXJ. Turn them on. Now here's your items. Flip those on, flip those on. And now, anytime again you get those start to drop, you're going to get an automatic email and a text saying stocks in your portfolio are dropping, turn around and sell them. So now just go back and sell them. If you want to, be done with it. Say, I don't have to keep on hanging on to those while they're dropping, because if you actually own something in your portfolio, like let's say you had SPX or the S&P 500 and it's dropping, This is kind of probably what your portfolio looks like right now. This is the entire marketplace. Your mutual fund manager is not going to sell, but you could sell and you can just be in cash. But you could also say, hey, my stock XLE just started to drop. What do I want to do now? Well, XLE was part of my equity ETFs. So now go back, click under equity ETFs, click on it, and bring up your list of equities. And now go back and look for another equity ETFs to replace the ticker symbol XLE. And you might have to do that once or twice a year. That's why I say about an hour. You might have to do it once or twice a year where your stock's going to actually start making lower lows. Get out of it. Don't hang on to it. There's no reason for that. And once or twice a year, you'll make a change in that portfolio. In the meantime, come back every year and just redo it. And take a look at what you have and say, yeah, I like what I have, but now I'm supposed to have this much money. So add a few more of those shares, add a few more different shares, whatever you want, and start making some cash. Making money isn't difficult. It's different. We're not born with the information. The tools didn't exist 30 years ago. Your parents couldn't teach this to you. It's now your time. Yeah, so a lot of cool different things out here. For training, can you tell us the feeling on the stock market in general, where I think it's going to go in the near future? Good question, Gregory. I like the stock market right now. I know it's volatile. The Fed waited way too long to raise interest rates. Generally, the Fed will raise interest rates or start to tighten the money supply, which means how much money they print out and supply to the banks, things like that. We'll start to raise interest rates or do something when the consumer price index, CPI, which is what's known as inflation, consumer price index, gets above 4. We went to over 8 before the Fed did something, just crazy. And just now, this last week, the Fed chairman came out and said, we may have waited too long. He says, really? Everybody else already thought that just months and months ago. So here's what I think for the marketplace. I think we're still going to move lower. We're still volatile. We're starting to find some bottoms right now. I honestly believe that, down here at about 25% on the lower end for the S&P 500 for the pullback, especially for the NASDAQ. I think we're probably still going to see some volatile days, which means we could even dip lower. But for the most part, I think we're going to start to find a bottom here really quickly, and we're going to start to go sideways. And I think we're going to have a pretty good rally or pretty good bounce towards the end of the year. I do see just from the news that and I'm not a political person here, but I do see from the news that it looks like the Republican Party is going to gain a few more seats in Congress, which means that they might try to start to change some of the rules, including, oil. And right now, the price of oil has a big effect on everything, because in order for you to get anything that you're going to buy, it has to be shipped there. Whether it's coming from wherever, it's got to be shipped there. And that's oil. So oil has an effect on everything, and that's part of the inflation. So I do think that if Republicans win, they're going to start to change some of the rules a little bit. And so that'll have an impact on the market, which is going to send it up. I'm not doing this for any political reasons. I'm just saying, what are some of the signs that are out there is what I'm looking at. But I do think that by the end of the year, we're going to have a rally by the end of the year. I don't know how strong just yet. If the Fed raises interest rates again for another ½ point next month, that'll cause the market to sell off. But at that point, I think we should be done after that point. And then we should just start to bounce around sideways, up days, down days, and then slowly start to kind of move forward, and then a pretty good rally towards the end of the year. So that's what I'm seeing personally, with all the signs that are currently out there today as an investor. All of that obviously could change based off of news, but that's where I see it kind of going today. Good question though. Any idea if interest rates will drop anytime soon? No, they're going to go up. If you're talking about interest rates, they're still going to go higher. If you're thinking about buying a house, they're not coming down for a while. They're still going to go up. Fed's going to raise rates again. I hope they do a ½ point next month. If they do a quarter point, that's not good, because we don't really know what's happening. But they're going to raise rates again, maybe ½ point next month, and then probably 5 more times before the end of the year, they're going to raise it another quarter point. So if you're thinking about buying a house, interest rates are only going higher, which should start to bring the housing market down a little bit. So you'll pay more for interest rate, but you'll be able to buy a house at hopefully at a cheaper price. When I'm speaking about ETFs, I asked, does a dividend-paying ETF such as XYLD or RYLD meet your criteria? XYLD, so dividend high yield, XYLD. So when we're looking at any of these items, no, it doesn't meet my criteria. And the answer for that is just because it's in a downtrend. I don't care how much something pays me if it's losing more than it pays me. So if it pays me 5%, but at this point here, it's already down 14%, it doesn't help me, 13%, it doesn't help me to pay 5% a year if it's already down 13% in just 2 months. So it doesn't fit my criteria. The first thing I'm always after, no matter what I'm looking at, I'm always after what is the trend. And especially if you're buying an ETF, which means you're buying a whole bunch of items in one basket, so you're diversified, you're really only looking at the overall trend. And what the overall trend means is buyers and sellers. Because in the stock market, I'm sorry, not XLF, it's XLE for energy. In the stock market, there's only two buyers and sellers, institutions and retail. We're retail. Institutions are the big institutions. And if they buy more than they sell, prices go up. So what I do know is all of these big 60,000 institutional money managers are buying this. They're not buying other things, they're buying this. So why are they buying this? Don't know, couldn't tell you, other than they think it's going to go higher. And so they're buying right now. And so because they're buying, price is still going up. And so that's what I want to do. I just want to go back and copy them. So I don't care what anything looks like fundamentally. I don't care what anything looks like dividend yield. I don't care about anything that I actually have in my heart, the things, but I like this because it makes no difference. If I'm buying something, I have one goal and one goal only, and that's to make money. And I don't make money if I buy, if it's heading lower. I make money if I sell, it heads lower, but if I buy. If I want to get on a, I use it all the time, if I want to get on a freeway going north, I can't accomplish my goal if I get on a freeway going south, because I think at some point it will turn north. It's always easier to start with one, go in the direction that you want, and that right now is XLE. So when I take a look at XLID yield, no, not at all. That was horrible. And I'm not saying that, you know, that's one that you love. I'm just probably saying you probably heard somebody else talk about it saying, oh yeah, these high dividends are great. And this is the same thing here. Here's a 6-month chart of this. If I look at a 6-month chart, what's it doing? It's just making lower highs and lower lows the whole way down for the last 6 months. I'm just not interested. I don't care what anybody else might tell me, what I hear on TV, what I read. If it's not going the direction I want, it's really difficult to accomplish my goals. So rule number one, it has to be heading higher. At the very, very least, it has to at least be going sideways. Because if it's going sideways, I can still collect the dividend and write some covered calls. So that's really good. Yeah, you can also do some iron condors on some different things out there too. Iron condors work really well, just because of the volatility. Just leg into them. Start, if it's a really big down day, do the bull put spread side. And on nice big rally days, do the bear call spread side. So you kind of have to leg into them, but they work really well because of the applied volatility is so huge right now. You can get some really, really nice moves on those. All right, so let's go back as I kind of wrap things up here. I didn't get enough forever to kind of go through this. I gave you guys a lot of information here, but really the goal here was I wanted you to learn how to make money. And making money isn't difficult. It's just different is all it boils down to. So it's just different. Make sure it's on the right screen. Yep. Okay, so it's just different. So get yourself educated, learn more about this here. If you want to come to a class, which you do, I've got a class that is coming up for all of this. You can get to the information here at protectwealth.com/stocks. It's an upcoming class. It'll be June 11th and June 12th. It's a 2-day class, a Saturday and Sunday. It's 11 a.m. to 6 p.m. If you can't make those dates, go ahead and register anyway. Send me an email and say, I'm looking for other dates because we've got other dates coming up as well. My next one here is June 11th and June 12th, 11 a.m. to 6 p.m. Eastern time. 2 full days. I'm going to go into much, much more detail than we did here, including once we have those stocks, ETFs, how do we write cover calls on? How do I get people to pay me monthly income for the rest of my life? So if I do only end up with a $300,000 portfolio when I retire, how can I still make about 2 to 3% per month income without ever having to ever touch the principal and just live off of money off that 2 to 3% a month writing cover calls? So on that one, start off with, I'm going to give you a cover call bonus on how to write cover calls. It's kind of a quick start tutorial, kind of get you going. We have our 2-day live class, which is the 11th and the 12th, and our website access, which is $25 a month, $24.99 per month on that. But right now, because we're working with Protect Wealth and they send us so many students that are qualified students for us, obviously you guys went to Protect Wealth for a reason, because they have different things they're teaching. They're looking for people who already have assets and might want to protect your portfolio with different items here. And also, how do we make some money at the same time? So we have a really good working relationship with Protect Wealth. Don and Kendall have been fantastic for our company to work with, and vice versa. And just some of the other speakers they have out there with Scott Estill. But entire thing here for 2 full day classes, $197. But I'm going to make this so easy here because I want you to actually come to the class. I want you to come to the class because you're going to learn so much information that you will not learn from anybody else. I had somebody call into the office today and said, hey, I just called TD Ameritrade, and the brokerage firm said that I couldn't sell naked puts inside my IRA. Is that correct? And I said, no, it's 100% not correct. I do it almost every other day. He said, well, they said I couldn't do it. And I said, as long as it's cash secured, and I had to kind of walk him through the rules, exactly how you can do it. And the point is, you're going to get so much bad information out there and so much information that's just garbled and all over the place. Let's get it focused and streamlined. And how do you personally have step-by-step process to make money and have a better retirement that people just aren't going to show you and or will charge you a lot of money. So tell you that you can't do this yourself. You got to go back to work. So I'm going to give you 100% money back guarantee. Take the entire 2-day course, guys. $197. Take the course. If you say, Mike, I didn't like it, I'll give you $197 back. I'm not going to go broke or rich because of it, but I want you to learn. So I'm trying to make this so simple that you can't pass this up. Then I want you to share it with your family, and I want you to share it with your friends after you take the course. Teach them how to do this so we can start changing our lifestyles. 100% money back guarantee, but go ahead and keep the quick start videos, which is on the covered calls. I want you to go ahead and keep that. And as a bonus, I want you to bring a guest with you to the class. And so they'll get complete access to the class as well. So have them come to the class with you. It's you plus one, but bring them to the class with you because you learn more the more that you do this. And so I'm going to give them complete access. So for $197, it's you and your guest. And as a bonus, I really, really believe in teaching kids this information. So we just started a new series called Teen Financial Training Video Series. We've got 3 videos so far. We'll have a 4th one out pretty soon. Usually it's best for teenagers, 13 to 19 years old. But if you want to get them excited and kind of get them into the financial markets and how money works, I got 3 videos already ready for them. Share them with them, and you'll be able to keep those and share them, download them, and share them over and over and over again. It's pretty cool. So all of that, get yourself started. It's only $197. It's at protectwealth.com/stocks. Get immediate access to the website. Once you register, you have immediate access. I'm going to send you your password. Your email address will be your username. I'm going to send you an immediate password to it. Your guest has access. They can log in using your same information, so you can both log in at the exact same time using your same username and password. Get your covered call video. Get your teen video series. You get a 2-day live interactive class with us. 60 days of website access is included in the $197. After that, it's $24.99 per month with 100% money back guarantee, because you can't mess this up. Yeah, you can do everything we're talking about here, Racy, inside of a college for your 529 plan, with the exception of you can't sell naked puts in there, but buying stocks and buying ETFs and even doing some of the covered calls, most 529 plans are going to say yes. Yes to ETFs and stocks, and about half will say yes to the covered call portion on that. Let's see, please explain the home course you're offering. The home course I'm offering here is kind of a quick start. It's kind of a quick start guide for what a covered call is. And basically a covered call is, if I buy a house as an investment, how do I rent it out? Well, if you buy a stock or an ETF, somebody will pay you cash to buy your stock at a higher price. You say, why would they do that? Well, that's the whole process. I want to teach you that. It's that way for almost every single ETF and stock that you're going to buy. Somebody will pay you cash to buy it at a higher price. It's called a covered call. Very, very popular in the market these days. I'm going to teach that to you. That's what this course kind of all comes around. How do I find good stocks and ETFs? When do I buy them? When do I sell them? How do I put in my sell orders? How do I read the charts that are going through there? And how do I make additional money? How can I make money 3 times on the same investment? That's what I'm after here. How do I use part of that leverage? I've got a 2-day class to teach you that. There's really, really great. Next one in June, Don, I see you're about ready to go here. Will be probably 2 weeks after that, I believe. I don't have the exact dates yet. But again, if you can't make this date here coming up, which is June 11th and June 12th, just send me an email after I send you your welcome email and say, can't make those dates. When is the next one? And I'll just let you know when the next one is. Otherwise, I'll get you started. And if you don't get an immediate email from me after you register, please check your junk mail folder, because that's probably where it went to. So protectwealth.com/stocks. Go there right now. Look at the information and register for $197. It's really, really difficult to pass this up, guys. My goal is get you there, get this information, learn it, have it for the rest of your life, never be afraid of the stock market, and now know when someone tells you you should buy something, you have the ability to go back and check that yourself and check it out. So Don, anything you'd like to add? I'm going to kind of wrap that up.
Yeah, a lot of people are asking about the recording of this, and it will be, the recording usually takes us half a day to, I don't know, to download and figure that out. But it'll be sent out to you probably tomorrow morning from Protect Wealth. So watch for your emails. Anyone who registered for this webinar will get the recording link tomorrow. Even if you attended 5 minutes or whatever, anybody who registered for the class will get the recording. But the class that he's talking about, the 197, you need to do something. That one, you go to protectwealth.com/stocks. We couldn't have made this any easier for you. And Mike, thank you so much. What?
Yeah.
thank you for doing this. What a tremendous bonus and great information. Thank you for that.
Thank you, Don.
Did we get to most questions? I think so.
Yes.
The
Do you have any live
charts
events
that
coming
are
up?
being showed are on your website, and that go to the class. Don't just go to his website and think you get it. Go to the class, understand it, and then after that, it's what, $25.
It's amazing. It's amazing how empowering this is when you know that you have the ability to make money for the rest of your life. It doesn't matter what the size of your portfolio is. The size of your portfolio is no longer relevant because you can make income off that portfolio on a monthly basis without ever touching the principal. And when you know you've got the ability to pay your bills every month, here's what's kind of cool. Stock market will be the last freedom that's ever taken away from you. And the reason for that, Wall Street needs your money. And so it's the only way that Wall Street works. They need your money, which is why you're taught to buy mutual funds. So they'll never take it away from you. So even though they might say your job is gone, you can't leave your house, you can't do this, stock market is still there. And so that's what's really cool. And it has no bias, no matter who you are. If you know you've got the ability to make money, it changes your whole mindset. It's very, very empowering.
Great. Thank you for everybody sticking with us. We've been here more than an hour and a half, and Mike, I so appreciate your time.
Thank you, Don.
Running
I
late.
went a little bit long today. I apologize for that, but I knew it was a webinar, so I can go as long as I want before you cut me off.
And we're delighted to have you always. Thank you, everyone, for being on, Mike. So appreciate the offer.
Thank you, guys.
But especially
protectwealth.com/stocks.
Great. Take advantage of that if you can. And then we'll see you, Mike, we'll see you in 2.5 weeks at the 3-day summit.
Okay. At the next summit, you bet.
Okay.
Okay. Thanks, everybody.
All right. Hey, thank you.
Bye-bye.
Good night. Bye-bye.